What if the money you are missing this year is not a mystery government check, not a lawsuit payment, and not one of those wild stories people pass around online, but a tax break that can let some older Americans protect well over $22,000 of income before the IRS even starts figuring the bill? And what if the reason so many people miss it is almost silly? They think the regular senior deduction already covers everything, so they never look for the extra part. I make these videos for one reason. I do not want older people losing money just because the rules were explained in tax language instead of plain English. If that sounds useful to you, stay with me because this one can save you confusion, stress, and for some people, real money. I know there are two kinds of people watching right now. One of you has been doing your taxes the same way for years, and you are tired of every new season bringing one more rule, one more worksheet, and one more thing to worry about. The other person just heard somebody mention a new senior tax break, and now you are wondering, wait a minute, did I miss something important? Both of you are in the right place. Here is the hidden truth. Most people do not miss money because they are careless. They miss money because they hear one true thing, then assume it means something bigger or smaller than it really means. They hear senior deduction and think, I already get that. Or they hear $22,000 and think it must mean a $22,000 refund. Neither one is the full story. This is fixable once you know exactly what to look for. I spend a lot of time reading retirement, tax, and benefit rules so I can turn them into regular English. I am not here to impress you with fancy terms. I am here to help you spot what matters before you sign, file, or toss a paper into the drawer and forget about it. So here is what we are going to do together. I am going to walk you through what this so-called hidden benefit really is, who it actually applies to, where people get tripped up, and what you should do next if you already filed an extension, or have not filed yet. I will also show you where the forms fit in without making this feel like homework. First, let's clear this up because this is the part that causes the most confusion. The hidden benefit is not a separate check. It is not a bonus payment. It is not some special Social Security deposit. What many seniors are really talking about is the new enhanced deduction for seniors that first showed up on 2025 federal returns, along with the regular standard deduction and the usual extra age-based deduction that many older taxpayers already know about. When you stack those pieces together, the total amount of income protected from federal income tax can be well above $22,000 for some older filers. Let me put real numbers on it. For a single filer in 2025, the basic standard deduction is $15,750. If you are older and qualify for the age-based extra amount, that can add more. Then the newer senior deduction can add up to $6,000 more if you qualify. That means a lot of single seniors can end up with more than $23,000 of total deduction before itemizing even enters the picture. That is why I say this is not fake, but it also is not a giant cash payment. It is a tax break that can lower the income the IRS taxes. Here is a simple example. Suppose Linda is 68, single, and besides Social Security, she has $12,000 from a small pension and $18,000 from IRA withdrawals during the year. She keeps hearing people say there is money for seniors, but nobody explains it clearly. What matters for Linda is not a free check. What matters is whether she gets every deduction she is allowed to get on her federal return. If she does, she may owe less tax than she expected. If she misses the extra senior deduction, she may quietly overpay. The action step here is very simple. Pull out your last return, your draft return, or your tax organizer, and write one plain question on the front. Did I get the extra senior deduction, or did I only get the regular one? Now let's look at who this really applies to, because this is where people start assuming too much. The newer senior deduction applies only if you are 65 or older by the end of the tax year. If you are married, the amount is counted per eligible person, so one spouse may qualify or both may qualify. If both spouses qualify and the couple files jointly, that extra amount can be as much as $12,000. But there are limits. Higher income households may see the deduction reduced, and for this break, married taxpayers generally need to file jointly to claim it. This is not one of those rules where every older person gets the same answer. Let me give you two very ordinary examples. Evelyn is 67, widowed, and files on her own. Her income is modest. She has Social Security, a small pension, and a little bank interest. She should at least check whether she qualifies for the full extra senior deduction. Now take Robert and Ann. Robert is 64, Ann is 66. They file jointly. In their case, only Ann meets the age rule this year, so you would not assume they get the full amount for both people. That one detail changes the answer. Then there is a third situation that catches people off guard. A married couple may have heard from years past that filing separately helps with one issue or another, but for this particular deduction, you do not want to assume you still get the same benefit. For many married seniors, the words file jointly matter more than they realize. Income matters too. Once income gets above the allowed range, the extra senior deduction starts to shrink. So if someone online says every senior gets this, that is not right. Some do. Some get part of it. Some get none of it. Your action step for this section is to circle 3 things before you assume anything: your age at year end, your filing status, and your rough income. Those 3 details decide whether this is a real benefit for you or just a headline you can ignore. And if you are sitting there thinking, now I need coffee, I understand. Stay with me, because the next part is where people really go sideways. The third thing you need to know is that a lot of people misunderstand how this tax break works, and that misunderstanding leads to bad decisions. The first mistake is thinking a deduction is the same thing as cash in your hand. It is not. A $6,000 deduction does not mean a $6,000 refund. It means up to $6,000 can be taken off the income the IRS taxes if you qualify. The tax savings depend on your situation. Here is a plain example. Suppose Harold is in a 12% federal bracket on part of his taxable income. If he qualifies for the extra $6,000 senior deduction, that could cut his federal tax by around $720. That is real money, and I would not laugh at it. But it is not the same as receiving $6,000 from the government. The second mistake is thinking this is only for people who take the standard deduction. That is not true. The new extra senior deduction can also matter for people who itemize. That surprises a lot of folks. Take Joan and Michael. They are both over 65 and they itemize because of medical costs, charitable giving, and property taxes. They almost skip over this new senior rule because they think, we do not use the standard deduction, so this must not be for us. That would be the wrong conclusion. The regular standard deduction and the new extra senior deduction are not the same thing. The third mistake is a big one, and I want to say this slowly because it matters. This new deduction does not rewrite the old rules that decide whether part of your Social Security may be taxable. Those older income thresholds did not suddenly vanish. What the new deduction does is lower taxable income later in the return. That can still reduce your overall federal tax bill, which is helpful, but it is not the same as changing the Social Security tax formula itself. That may sound like a small distinction, but it keeps people from making sloppy decisions. If somebody tells you, this means your Social Security is now completely tax-free, do not accept that sentence without checking the numbers. Here is your action step for this section. If a preparer is helping you, ask 2 direct questions in plain English. Did you include the extra senior deduction? And did you also check whether I qualify even if I itemize? If you do your own return, look for the extra deduction worksheet and make sure it was not skipped. And if you have ever sat in a tax office smiling politely while secretly thinking, I have no idea what that person just said, you are not alone. Half the country has done that at least once. Now let's get to the fourth thing, because this is where timing matters, and this is where checking too late can cost you the most trouble. A lot of people hear 2026 deadline and think the story is over if April has passed. Not always. If you filed a proper extension for your 2025 return, your filing deadline can run later in the year. That means this still matters right now for some people. On the other hand, an extension gives more time to file, not more time to pay. So if tax was owed, that is a separate issue. And if you already filed and never checked whether the senior deduction was on the return, you may still need to review it. Let me show you the stronger example. Tom and Carol are both 71. They have Social Security, pension income, and IRA withdrawals. Together, they also had enough other income that they were not in the tiny tax bill category. If both qualify for the extra senior deduction, that can mean up to $12,000 more in deductions on the federal return. If part of their taxable income lands in a 22% bracket, missing that extra $12,000 could mean paying as much as about $2,640 more in federal income tax than necessary. Now think about the difference between checking in time and checking late. If Tom and Carol filed an extension and catch the issue before they file, good. They can finish the return the right way the first time. If they already filed and the deduction was missed, now it becomes a correction job. That is not the end of the world, but it is more hassle, more papers, more waiting, more chances to procrastinate. If someone has not filed yet and the IRS actually owes them a refund, they still should not shrug and walk away. People sometimes hear, "I was not required to file," and assume nothing to do. But if money is sitting on the table because a deduction was missed or too much was withheld, that return may still be worth filing. If someone owes money, filing sooner is usually better than hiding from the envelope and hoping it gets lonely and goes away. It never does. So here is the action step that matters most in this whole video. If you filed an extension, put your real finish date on the calendar now and do not wait until the last week. If you already filed, pull the return and see whether the extra senior deduction was actually claimed. If you cannot tell, ask a qualified tax preparer, an AARP tax aid site, or an IRS tax counseling for the elderly program to help you review it. Now let me give you a quick check-in because this is where people start breathing easier. You do not need to master the whole tax code tonight. You just need to stop guessing. That alone puts you ahead of a lot of people. And since you stayed with me this far, let me give you 2 bonus points that can save you even more frustration. The first bonus point is a useful strategy, especially if you take money from an IRA, pension, or part-time work income during the year. Do not treat this deduction like permission to pull money out carelessly, but do use it as part of your planning. If you know you may qualify for the extra senior deduction, that can give you a little more room before your federal tax bill rises than you had under the older rules alone. Let me make that simple. Suppose Diane usually pulls $10,000 from her IRA every fall for property taxes, home repairs, and Christmas. In past years, she guessed at the tax hit and often withheld too much because she was afraid of owing. This year, instead of guessing, she can ask one better question. Given my actual income, how much of this withdrawal is comfortably covered by my deductions? That is a much smarter way to think. This does not mean every extra withdrawal is tax-free. Please do not hear that. It means the deduction can change the math enough that you should run the numbers before you decide how much to take and how much to withhold. Your action step on this bonus point is to review one planned withdrawal before you take it, not after. A 5-minute conversation with a preparer or a careful look at your estimate can beat a 5-month headache later. The second bonus point is a warning, and I mean it kindly. Do not assume your state tax return follows the federal rule. Some states copy federal tax law closely, some do not. Some offer their own breaks for retirement income, some do not. So if someone says, "This wipes out tax for seniors," the first question should be, federal, state, or both. Here is another quiet mistake people make. They hear about a new deduction and suddenly somebody wants to sell them a whole new financial product. Maybe an annuity, maybe some expensive strategy session, maybe a big promise about paying no tax at all. Slow down. A tax deduction is not a reason to buy something confusing. If the numbers are real, they should be easy enough to show you on paper. Your action step there is simple. Before you sign anything or move any money, ask to see the exact dollar effect on your own return, not a sales story built around somebody else's case. Now let's pull the whole thing together. The main idea is this. The so-called hidden benefit is not a surprise check. It is the chance for qualifying seniors to claim every deduction they are entitled to, including the newer extra senior deduction, so more of their income stays out of federal tax calculations. For some single filers, that total protected income can be well above $22,000. For some married couples, it can be much more, but it depends on age, filing status, income, and whether the return was done correctly. Why does that matter? Because missed deductions are one of the quietest ways older people overpay. No drama, no flashing warning sign, just a line that was skipped, a question that was never asked, and money that never had to leave in the first place. And what should you do today? Check whether the extra senior deduction was actually claimed on your return or draft return, not whether somebody mentioned it, not whether you think it was probably included. Check. One thing before you go. If you have a brother, sister, cousin, neighbor, or old friend who always says, I just let the tax people handle it, send this video to them, not to scare them, just to help them ask one better question before another filing season slips by. And in the next video, I want to talk about another mistake that costs older households more money than they expect, how a perfectly normal IRA withdrawal can push you into a tax surprise if you do not handle the timing right. That one catches good people every single year, and I want to show you how to spot it before it happens.